What's going on, guys, and welcome back to another video. So with a new week upon us, this week I want to focus on three main factors in terms of investing, and I'm going to discuss all three of those in today's video. So the first of these aspects is dollar cost averaging. So again, if you've seen any of my prior videos on my portfolio, the main premise of investing on this channel is the dollar cost average. And at the moment we have 31 stocks. Again, besides diversification, the main reason to hold so many is to always have an opportunity to dollar cost average. At the moment, we have about €8,284 invested, up 15.2% or €1,092. So at the moment, I'm probably in a situation that I suppose you can't complain about in terms of having a majority of my stocks in the green. So effectively, I can't really dollar cost average into a lot of them at the moment. In fact, 29 of the 31 are currently in the green. So I suppose that's not a good problem to have either, I suppose. But we can see even on the left here, the likes of 3M is up 20.5%, AbbVie is up 24.7%, Alphabet Class A is up over 40%, we have the likes of Alphabet up over 10%, Bank of America up over 61%. We then have a few more 40 to 80% gains in the form of Caterpillar's up 50%, Chevron is up nearly 50% as well, Coca-Cola up over 11%, ExxonMobil is up over 70% if we keep going down on the left, Goldman Sachs is up 66%, IBM is up over 17%. We then have the likes of JP Morgan up over 60% as well, a few 15% gainers in the form of Johnson & Johnson. Also, if you look on the left, MasterCard, Microsoft, PepsiCo's up over 10% as well. And on the final kind of section of my stocks, we can also see the likes of Waste Management up 17.7%, Walt Disney is up nearly 50% at the moment, Visa up 9%, Vanguard SP 500 up nearly 20%, we then have the Vanguard FTSE 100 up over 15%, etc, etc. Again, that's probably one of the main benefits of having so many stocks, is that you nearly always have an opportunity to dollar cost average, even when we're in a bull market. So at the moment, you probably saw on the screen, we have two in the red, and they're kind of both in the red a fair bit, nearly double figures, in the form of the iShares Global Clean Energy ETF and Tesla. So the first of these was the iShares Global Clean Energy ETF. We can see we have 24.5 shares, are down 10.79%, so that's definitely one of my worst performers at the moment. But again, long term, as I do believe this has a lot of potential, this is just a discounted price in my opinion, and long term, if you continue to get in at a discounted price, we can see the dotted line here down below. My average price is about £10.65, where it's now sitting at £9.46. So again, if I buy more at the current prices, this line will slowly start to come down, and long term, hopefully, it will get back up to its highs. So that's my main premise of why I'm going to continue buying on the dip, to get a cheaper overall average price, effectively give me a better profit long term. Also shows the importance of not putting all of your cash reserves straight into a stock to dollar cost average. For example, we can see over the last month or 3 month chart here that has continued to go down in value. So even if we bought at, let's say, the £10 mark, if we put all our capital in at that stage, it still has dropped another 50 pence or so. So we are actually losing out. So that's definitely why I only put in small amounts of money into dollar cost averaging stocks any given time, as consistency and slowly trickling in funds long term will give you a better overall result. You could also say then, oh, what about if it goes back up in value? You kind of lost the opportunity to buy in the dip. But that's kind of well and good as well, because either way you're actually getting a benefit, in my opinion. So like, for example, if it continues to drop even further, you can still buy more at an even cheaper price, which will give you an even cheaper overall average cost. Or even if it goes back up in value, fair enough, you're actually gaining profit as well from that. So either way, it's a win-win situation. And the second company that I can dollar cost average into is Tesla. Again, Tesla and the iShares Global Clean Energy ETF are the two stocks/ETFs that I've been able to dollar cost average in the last few weeks, as all other 29 of my stocks have been in the green, thankfully I suppose. So at the moment, Tesla is down 10.7%. We have 0.63 of a share. So I'm kind of hoping over the next few weeks to get this up to 1 full share. At the moment, we can see my average cost was $706 on the dotted line, and it's currently trading at $618. As I'm sure you're already aware, Tesla was down about 21 or 2% in my portfolio a few weeks back. So by dollar cost averaging in, and also by the stock improving, it's now after cutting that in half and still down 10%. So long term, again, I do think Tesla is going to be volatile over the next few years. It could drop a lot more than it's at now. That's why I only want to put very small amounts of capital in at any given time to kind of help counteract my risk. Now that's one of definitely the main benefits of Trading212, being able to buy fractional shares. For example, it's going to be very hard as a small investor to dollar cost average into the likes of Tesla if they're trading at about $600 or $700 a share at any given time. So that's one of the problems I will face on DeGiro, but we'll discuss that later on. So on Trading212, it's certainly of huge benefit that you can buy tiny quantities of a share at any given time, which really does make dollar cost averaging a whole lot easier. So that's just the first point I wanted to go through in today's video. The two stocks that I'm going to dollar cost average into this week, or ETFs as well, should I say. So I don't usually invest on a Monday morning because usually the markets do go up before it kind of dips. So I'm going to wait until about Wednesday or maybe even Thursday this week. Firstly, to see how both of those stocks / ETFs are performing, and second of all, to see if any other of my 29 other stocks, if any of them have went into the red as well. So it's going to be about Wednesday or Thursday once I invest further into these two stocks / ETFs. So the second topic I want to tackle this week, and again, it's probably a good problem to have, is taking profits. So when I started this kind of strategy of dollar cost averaging, I didn't really think long term in terms of when it actually will go into the profit margin. So I'm obviously happy with how it's performing at the moment, as 29 of the 31 are currently in the green. So you kind of always have to rebalance and restructure your portfolio, especially during different market conditions. For example, if it's a bull or bear market. Now on screen, I've done up a quick, very simplistic chart there about what percentages I'm currently moving in my stocks. For example, 2 of the 30 are in the red, which again we went through already. That's about 6.4% of my portfolio in terms of stocks. So then 0 to 10% is 22.58%. 10 to 20% is 38% of my stocks. Then we have 20 to 30% in the green is 6.4. We have none in the 30 to 40% margin. 40 to 50%, we're up 6.45% of my stocks. Then stocks that are up 50 to 60% is 2 stocks. We have 3 stocks up 60 to 70%. And finally, my best performing stock at the moment is up 70 to 80%. I should have probably made that a bit clearer. On the left is the gains, so what percentage they're actually up in terms of value. So that's the first kind of column here. The second is the amount of stocks within my portfolio that are in that bracket. And again, the percentage of the portfolio is the percentage on the right here. So I have been thinking about this over the last few weeks. My first kind of opinion was just to leave it ride. But then, for example, the stocks that are up, let's say the 70 to 80%, I know it's only 1, but we have 3 that are up 60 to 70, 2 up 50 to 60, and so on. So you'd wonder if they can kind of continue their growth as such. So that was one of my kind of concerns, that these ones that are up a lot, let's say the 60, 70% ones, and again, we have a few in a lot of the different brackets here, but predominantly we're up at least the 10 to 20% mark. So I was gonna leave them all at the moment. Well, I still will leave them for now, I suppose, but I need to actually sit down properly, and I've said this a few times over the last few weeks, that I do need to sit down and actually think about what I actually want to do with these stocks. For example, either number 1, leave them as is. Number 2, let's say sell out at a certain portion. For example, any stocks over, just an example, the 20% mark, sell the profits there and then reinvest into new stocks or into stocks such as the 2 in the red here. So that will help drag up the worst performing stocks and will even out the best performing ones. And the whole objective there is to give me a better overall profit. And then the second kind of strategy I was thinking is to sell the full portfolio, which would then lock in the profits of over €1,100 at the moment. So then I would reinvest straight away, so I wouldn't be actually taking any money out of the account. It would just be locking in that €1,100 profit, and then start off again from scratch in terms of buying, let's say, 1 share of each of the 31 stocks again, and then slowly dollar cost average in, just like I've done already. So that way, again, if the markets continue to go up, I'd be still making more money. But if they started to dip, which they could easily do in the next few weeks or months, I would then be getting in at a cheaper average price yet again, which would kind of improve the top line here, and that's the most important figure, your overall account balance. As I said, I have been saying this quite a lot now, so over the last few weeks. So this week I put it on the agenda as one of my 3 main concerns to actually decide what I'm going to do. And the second, when I actually decide, I'll be sure to let you know. And the third topic that I want to kind of focus on this week is DeGiro, my second broker alongside Trading212 that we discussed in yesterday's video, the broker that I'm going to use going forward as well. Again, this is just to help protect my capital once it starts to grow. So I am going to start thinking long and hard as well about what I'm going to do with this portfolio. Obviously, I don't want to just invest in the exact same 31 stocks that I do on Trading212 here on DeGiro as well. I do want to start looking into different markets outside of the US, maybe some of the European or emerging markets as well. So I'm going to kind of start looking at a template of firstly how many stocks I want to hold within DeGiro, and secondly start transferring capital in here as well. Again, I'm only going to start putting small amounts of capital into DeGiro at the start, but slowly, just like Trading212, hopefully to build it up long term. But that's it for today's video. As it's Monday, I just wanted to give my brief overview of the 3 things I'm focusing on this week. Firstly, dollar cost averaging into those 2 stocks that we mentioned. Second of all, I'm thinking about taking profits from some of my better performers. And thirdly, again, is my plans with DeGiro going forward. If you found this video anyway helpful or entertaining, it'd be much appreciated, as always, if you're new around here, if you consider subscribing to the channel. And if you have any questions, comments, queries, or suggestions, please don't hesitate to comment below, and I'll be sure to get back to you as quick as I can. Thanks very much, have a good Monday, and I will see you all in tomorrow's video.